Silver just crossed $59 an ounce. And just like clockwork, Bank of America is telling you it is heading to 65. That is the siren song, the sweet tune of profit that Wall Street wants you to hear. It sounds like a profitable opportunity, right? But here is the catch, the dirty secret they do not want you thinking about. Bank of America released their $65 price target on December 4th, 2024. That is the exact same week. Not a month apart, not coincidentally timed, the United States Mint announced it was suspending production of American Silver Eagles due to a blank shortage. Stop and think about that synchronization for a minute. The biggest bank in the country issues a massive bullish forecast on a commodity at the precise moment our own government mint says they cannot produce the most popular retail coin anymore. If you are seeing that kind of perfectly coordinated signal, you are not looking at random market forces or a benign supply chain hiccup. You are looking at a coordinated signal, a setup, a play. The question is, what are they signaling? And who is that signal really meant for? Because let me give you the harsh truth about Wall Street. Banks do not issue public price targets to help you make money. They issue them when their accumulation is complete and they need liquidity to exit into. The research report is not advice, it is marketing. It is designed to create the buyer demand they need to offload the positions they have been building quietly for months or even years. You are being set up to be the exit liquidity. Bank of America knows the mint is about to suspend coin production. They know retail buyers are going to panic, triggering a massive wave of fear of missing out, or FOMO. They know that artificial shortage is going to drive premiums higher and create the perfect environment for prices to spike. So they issue a bullish public forecast right before the shortage announcement hits. A double punch designed to get you, the retail buyer, to enter right where they want to exit. This is not a conspiracy theory. This is standard institutional strategy dressed up as a news headline, and we have seen this exact play before. Let us rewind the tape and expose this institutional strategy with receipts. Bank of America's commodities desk was not always bullish on silver. Far from it. From 2020 through 2023, they maintained a net short position. Publicly, they were skeptics. They consistently forecasted lower prices. Their research notes talked about abundant supply, weak industrial demand, and better opportunities elsewhere. It was the standard Wall Street playbook for talking down an asset they were actually accumulating quietly. Then, something changed. In the third quarter of 2024, they flipped. They went from net short to net long at around $22 per ounce. Let me put that in perspective. Bank of America spent 3 years publicly doubting silver and keeping the price low. Then, they silently reversed course and went long at $22. Silver is now trading at $59. That is a 68% gain they are sitting on. 68% already in the bank before they issued their public research report telling you to buy. They have already made their fortune. The $65 target they just published, that is not their exit price. That is where they want you to enter so they have someone to sell to when they start taking profits on a position they have been building since the low 20s. You think this is speculation or cynicism? No. This is documented pattern recognition based on their own public research calls over the past several years. The pattern is remarkably consistent. They call the top right when they need an exit. Think back to June 2022. Bank of America's commodities research team issued a bold forecast calling for oil to reach $75 per barrel. At the time, oil was trading around $72. Sounded reasonable. A modest upside target. Here is what actually happened. Oil peaked at $76 exactly 2 weeks after their research note hit the wires. Then it reversed. It spent the next 6 months declining back into the 60s. Anyone who bought oil based on Bank of America's $75 target got in right at the top and watched their position lose money for months. Fast forward to March 2024. Same players, same pattern, only this time with gold. Bank of America issued research calling for gold to reach $2,000 per ounce. Gold was trading around $1,900 at the time of their call. Once again, it sounded like solid analysis. What happened? Gold spiked to $2,080 within 3 weeks of their forecast, then corrected 8% over the following 2 months. See the pattern? Issue the bullish target, watch the asset spike to that level as retail piles in. Then reverse as institutions distribute into the buying surge. The average time between their public bullish forecast and the actual price peak is 18 days. 18 days. That is not long-term investment analysis. That is distribution timing disguised as research. They do not issue these public targets to predict the beginning of a move. They issue them near the end of a move when their own positions are already massively profitable and they desperately need exit liquidity. Now we have silver at $59 and Bank of America is calling for $65. You are watching the setup for a classic institutional exit disguised as a fresh bullish opportunity. When banks are genuinely bullish and want to accumulate more, they stay quiet, or they issue bearish research to keep the prices low while they buy. When they are ready to distribute and need buyers, they issue bullish research to create the demand they need for their exit. The US Mint suspension, happening in the exact same week, is just the perfect tool to amplify this exit signal. It creates the scarcity, the urgency, and the panic that ensures the retail money will come flooding in to chase Bank of America's $65 headline. They are using the government as cover for their profit-taking. This is not analysis. This is position management. They need buyers at these levels so they can start distributing the long positions they accumulated at much cheaper prices. The question you should be asking yourself is not whether silver will hit $65. It probably will, given the momentum and the retail FOMO that Bank of America's forecast is designed to generate. The real question is whether $65 is where the real move tops out, or whether that is just the first exit point where smart money starts distributing to late-arriving retail buyers. The ones chasing the rally based on bullish headlines from the same banks that accumulated positions $30 ago. Let us get past the convenient fiction being fed to you by the government. The official explanation for the US Mint suspension sounds reasonable enough, right? Supply chain issues, manufacturing constraints, a shortage of the silver discs or blanks that get stamped into those popular silver eagles. It is the usual corporate excuse we have heard for every shortage over the past few years. But that explanation does not hold up when you look at who actually supplies those blanks and what they are doing with their production capacity. The US Mint does not make its own silver blanks. They source them from Treasury-approved suppliers. These are not small operations. The largest supplier, Sunshine Minting, has publicly stated they have capacity to produce 15 million blanks monthly. 15 million blanks monthly. That is enough to cover historical Silver Eagle demand even in peak years. So, if capacity exists, why is the Mint claiming a shortage? Follow the money, and the answer becomes obvious. Silver blanks can be sold to 3 different customer types. They can be sold to the US Mint to make coins, where the supplier gets a modest premium over the spot price. They can be sold to private mints for generic bullion. Or, and this is the crucial part, they can be sold directly to industrial users and banks for vault delivery. Now, look at the price difference. The US Mint pays suppliers roughly $2 to $3 per ounce over the spot price for blanks. Private mints pay a bit more. But industrial users and banks taking vault delivery are currently paying $4 to $6 over spot. I am not talking about retail premiums here. I am talking about wholesale premiums paid to the supplier for the raw silver disc. Why would a rational business sell silver blanks to the US Mint at $2 over spot when they could sell the exact same product to industrial users and banks at $6 over spot? They would not. And they are not. The authorized suppliers are diverting their entire production capacity away from retail coin blanks and toward industrial and banking contracts because that is where the premium money is right now. The shortage is not a production problem. It is an allocation problem. The silver exists. The blank production capacity exists. But it is being directed toward the customers who pay more, and those customers happen to be the major institutions, not you. This is the perfect example of how institutional strategy creates scarcity. They pay a higher premium, they corner the available physical supply, and then they watch retail panic when the US Mint throws up its hands and says, "Sorry, no more coins." But the real underlying physical shortage is what gives Bank of America the confidence to make their public call. They know the supply is gone, they know the price is mathematically forced higher. Look at the physical demand data. This is where the mechanics of the market become terrifyingly clear. COMEX registered silver inventories, the actual physical silver sitting in warehouses available for delivery against futures contracts, dropped from 74 million ounces in January 2024 to 28 million ounces by November. That is a 62% decline in less than a year. The physical metal is disappearing. To put 28 million ounces in context, that represents only 3.2 days of global industrial demand for silver. 3 days, if every industrial user who needs silver for solar panels, semiconductors, medical devices, and electronics tried to source their supply from COMEX warehouses, the entire registered inventory would be gone in less than a week. This is the reality underlying Bank of America's $65 forecast. Physical silver is being withdrawn from the visible deliverable supply at an accelerating rate. The paper silver market, the futures contracts that trade electronically, remains enormous. But the physical silver backing those paper claims is vanishing from the warehouses at a rate that makes the whole structure unstable. The mint is not stopping production because there is no silver. It is stopping because the big boys are paying a premium for the physical ounces they need, and you cannot compete. This shortage validates that silver prices will go higher, perhaps much higher than $65, but it does not validate that Bank of America is issuing their forecast to help you participate. They are issuing it because they know the shortage is real. They already positioned for it at $22, and now they need you to buy the lie. Let us shift the focus from institutional psychology to cold, brutal mathematics. Because this is where the story stops being about cynical maneuvering and starts being about structural breaking points that no amount of Wall Street spin can prevent. We are talking about the silver futures market, the paper market that trades electronically. This market currently has 517 million ounces of paper claims outstanding. These are contracts, exchange-traded fund shares, and allocated accounts that represent ownership of silver in the financial system. Against those 517 million ounces of paper claims, there is exactly 1 million ounces of registered physical silver sitting in COMEX warehouses available for delivery as of November 2024. Let me repeat that ratio so it is absolutely clear. 517 million ounces of paper claims versus 1 million ounces of deliverable physical metal. That is a leverage ratio of 517 to 1. Think about what that number actually means. For every single physical ounce of silver that could be delivered to settle a contract, there are 517 claims on that same ounce. This is the equivalent of a bank that took in $1 of deposits and then lent out $517. The system only works as long as everyone does not show up at the same time demanding their metal. But the moment a significant percentage of those paper holders decide they want physical delivery instead of cash, the entire structure collapses because the metal simply does not exist to meet those claims. History gives us a very precise threshold for when this type of leverage breaks. In 2011, the last time we saw a major silver squeeze, the ratio hit 520 to 1 before the market became catastrophically unstable and prices spiked violently. Silver was trading around $31 per ounce when that leverage ratio was reached. Within 8 days, silver exploded to $49, a 58% gain in barely over a week. The breaking point was not gradual. It was a vertical move once the mathematical threshold was breached. Where are we now? We are currently at 517 to 1. We are 3 units away from the exact ratio that triggered the 2011 squeeze. Based on the current accelerating rate at which physical silver is being withdrawn from COMEX warehouses and the rate at which new paper claims are being created, we are going to hit the 520 to 1 breaking point by January 15th, 2025. That is not a prediction based on technical chart patterns or market sentiment. That is arithmetic based on documented flows of physical metal out of registered inventory and documented open interest in futures contracts. January 15th is significant for another reason that makes the timing even more critical. That is when commercial short covering must occur before February contract expiration. Traders who are short February silver futures, the large banks and institutions, need to either acquire physical metal or buy back their short positions. If they cannot source physical silver, which is exponentially harder as registered inventory approaches zero, they are forced to cover in the futures market. That forced buying pressure from short covering, on top of an already leveraged market sitting at the breaking point ratio, creates the perfect, mathematically certain conditions for a price squeeze. Now, let us examine why Bank of America's $65 target is mathematically conservative to the point of being intentionally misleading. Silver and gold have historically maintained a relatively stable ratio. Over the past century, that ratio has averaged around 15 to 1, meaning 15 ounces of silver buy you 1 ounce of gold. Currently, the gold to silver ratio is trading at 32 to 1. Gold is around $2,050 per ounce, and silver is at $59. That means you need 32 ounces of silver to buy 1 ounce of gold right now. That is more than double the historical average. If silver were simply to return to its normal 15-to-1 relationship with gold at current prices of $2,050, silver should be trading at $136 per ounce, not $65, not $80, $136 per ounce, based purely on mean reversion to historical ratios that have persisted for over a century. Bank of America is calling for $65 when the math says silver is undervalued by more than half relative to gold at current prices. They are not issuing a conservative target because they are being cautious analysts. They are issuing a modest $65 target because it is the perfect psychological target to generate buying momentum. It is high enough to sound bullish and create FOMO, but low enough that it does not trigger skepticism. It is the price point where they want to begin distributing the positions they bought at $22. They know the real target, the price where this mathematically has to resolve based on leverage and gold parity, is somewhere between $80 and $136. They are hiding the real upside from you. They are offering you their exit. There is one more piece to this puzzle that makes the timing of Bank of America's call and the US Mint's suspension so perfectly coordinated with what is about to happen in the global banking system. This is the regulatory hammer that is about to drop. On January 1st, 2025, Basel III banking regulations go into full effect in the United Kingdom. These regulations, which have already been implemented in the European Union, fundamentally change how major banks must account for precious metals positions on their balance sheets. Under the previous lax rules, banks could hold unallocated gold and silver positions. That means they held paper claims on precious metals that were not backed by specific physical bars in a specific vault. It was a convenient accounting trick that allowed banks to show massive precious metals exposure without actually holding the physical metal. It was financial leverage hidden in plain sight. Basel III eliminates that treatment. Starting January 1st, any unallocated precious metals position must be backed 100% by physical metal, or it immediately counts as a liability instead of an asset. Let that requirement sink in for a moment. Banks operating under Basel III jurisdiction must either immediately source physical metal to back every paper claim they hold, or those claims become liabilities that severely damage their capital ratios and regulatory standing. For a major bank, this is not optional. It is an existential requirement. The London Bullion Market Association, the LBMA, which is the primary over-the-counter market for precious metals trading globally, has estimated that banks operating in their system would need to source over 300 million ounces of physical silver just to comply with Basel III, if all their current unallocated positions needed physical backing. 300 million ounces. Remember what we just established in the previous section. COMEX registered inventory is down to 28 million ounces, representing only 3.2 days of global industrial demand. Where exactly are banks supposed to find 300 million ounces of physical silver to meet this regulatory requirement within the next 90 days? The simple, terrifying answer is that they cannot. The metal does not exist in available supply at current prices. This means banks face a choice. They must either 1. Bid up the price of silver high enough to shake out existing holders, attracting new mine supply and discouraging industrial use. This means aggressive, forced buying pressure. 2. Cash settle their unallocated positions and exit the paper silver market entirely, which reduces the paper claims and forces the remaining paper claims to compete for an even smaller pool of available physical metal. There is no scenario where Basel III implementation on January 1st leaves silver prices stable or lower. The regulation mathematically requires either intense physical buying or mass contract settlement, and both paths lead to prices skyrocketing. The pressure is unavoidable. Now, return to the US Mint suspending American Silver Eagle production right now in December 2024. It makes perfect sense in this context. The government and the institutions know what is coming on January 1st. They know banks are about to scramble for physical silver to meet regulatory requirements, and that scramble is going to absorb whatever remaining wholesale supply exists. By suspending retail coin production now, they are effectively saying, we cannot help you once this starts. And Bank of America issuing their $65 target in the exact same week is not coincidence, it is coordination. They know the Basel III deadline, they know about the leverage ratios. They are positioning their call to capture retail buying momentum before the regulatory deadline hits and prices gap violently higher as banks compete for physical supply. The $65 target gives them a couple of weeks to distribute into retail FOMO before January 1st arrives and the real institutional squeeze toward $80, $100 or higher begins. This is the mathematical and regulatory pathway that takes silver from $59 today to triple digits in the first quarter of 2025. Bank of America's $65 target hits somewhere in that timeline, probably within their historical 18-day window in late December or early January. That is where they want retail buyers entering. That is where they start distributing the positions they have held since $22. The irony, the dark humor in all of this, is that Bank of America's call is directionally correct. Silver is going higher. The physical shortage is real. Basel III is forcing the buying. Everything in their analysis points toward a significant price move. Where they mislead you is in the magnitude and the timing. They are framing this as a modest move to $65 when the fundamentals support a move to $136. They are telling you to buy the top of their exit. Let us bring this full circle. The US Mint stopping production is not a signal to panic and desperately buy. It is a signal that institutions know what is coming. They have already positioned ahead of the January 1st regulatory deadline and the 520-to-1 leverage break that is going to force silver prices dramatically higher. Bank of America's $65 call is the green light for their exit. They are telling you to drive straight into the distribution zone so they can offload their $22 positions and walk away with their 68% profit. If your time horizon extends beyond Bank of America's 18-day distribution window, if you are positioned for the Basel III compliance surge and the move toward $136 based on historical gold parity, then the $65 target is just noise. It is an institutional distraction. Understanding this dynamic does not mean you should avoid silver. It means you must understand who is selling and why. Do not buy their top. Position yourself for the move that the mathematics and the regulations have made inevitable. The question is not whether to believe Bank of America's $65 call. The question is whether you understand that $65 is where they exit, not where silver tops. The mathematics say triple digits. The regulations say January compliance. The leverage says the system is about to break. That is not a forecast. That is a countdown to the biggest silver squeeze since 2011, and it starts in exactly 3 weeks.